Welcome back. This is the second video of the series Masterclass with Super Investors. Today we have Govind Parikh sir. He is the managing director of Govind Parikh Securities Private Limited since the past 22 years now. He is 65 years old and by qualification he is a chemical engineer but joined the Madras Stock Exchange as a broker as soon as he graduated. His uncle Mr. Khandwala and Mr. Kishan Choksi were his mentors and helped him to formulate his initial investment strategies. Through the course of this video, we are going to learn about his major ideologies and learnings. I would like to invite Parva to take the video forward.
So we will start with Mr. Govind Parikh's process of filtering companies. While filtering companies, Mr. Govind thinks that the first step is to look at the fundamentals of the companies. That is, if it is able to grow its revenue and is able to convert it into cash, or it is able to shrink down its leverage over time, etc. After that, AGM. He says to gain more information about the company, he likes to go to AGMs so that he could understand more about the sector and the culture of the company. Scuttlebutt. To get information advantage over other investors, Mr. Govind likes to use the way of scuttlebutt by visiting factories of the business, knowing about future of the technology in the industry, edge over competitors of the business, and more. Govind sir talks about a company called Lakshmi Machine Works, in which a global player named Writer Machine Works had a 10% stake, which he thought was a good sign, as the company could have benefited from the technology and governance of Writer Machine Works. This contributes to build our conviction in the company. Management. Govind sir focuses on the quality of management, so he looks if the company is properly governed and does not do any foul play. Management should always be looking for increasing the potential of the business, which can bring growth to the for the business and for the shareholders. Valuation. When we talk about valuations, the first thing to check is if the business is overvalued or not. Further about valuation will be explained in the next slide. Valuations. Mr. Parikh uses a valuation metric in which he calculates PE on the basis of PBDT instead of PAT. PBDT is profit before depreciation and tax. He uses this because PBDT gives us a clearer picture of the business as it does not include depreciation cost in calculation. When we calculate PE from PAT, it includes depreciation. Both of these metrics includes interest cost, but PBDT does not include extraordinary items. Thus, it makes the PBDT ratio a better metric to judge operational efficiency of the business. Generally, this ratio is used for asset-heavy businesses. Govind sir has a thumb rule that a price to EPS calculated on PBDT is an investable company, but you should always look at the future cash flows of the business and the price to PBDT of its peers.
Now, here we are going to understand a wonderful case study of Govind sir. In this case study, we are going to understand that how a single line from management can open up a very insightful information for the investor. Like you can see that Govind sir had met the chairman of the MRF. He get to know about that the margins of the business is going to increase. We are going to understand that with a dummy example that how this is gonna help Govind sir. Like you can see, we have taken quarter 1 as the past quarter, quarter 2 as the current quarter, and quarter 3 as an estimated quarter. If you will see, the fixed assets is increased from 300 to 400 from quarter 1 to quarter 2. But if you will see, increased from 900 to 960 because the new capex doesn't start bringing up the revenue to the business in the initial times, so it takes some time to get in the operation. But if you will see, in the quarter 3 the revenue has increased from 960 to 11,060. It is because of the it is because of the new assets which the company had set up. The company only set up the not only but mostly the company set up the new plants is to increase the capacity to meet the excess demand. So now you can see that the margins is going to increase from 20% to 27% because of the operating leverage. If you not know that what is operating leverage, in the simple words, operating leverage means that with increasing production, your average cost per unit will start decreasing because of the high fixed cost. So because of that, now the profits has increased from 107 to 189, and this is how this is going to help the shareholders. You can see that the ROE of the business has also, the ROE of the shareholder also increased from 54% to 95%. So now you can see that a single line from the management how can give you the path of future for the shareholders.
Okay, so coming to the topics of Govind sir, the first one which we will talk about is Ramco Cement. In Ramco Cement, he loved the quality of management which the company had, which he got to learn from the general annual meetings which he attended. Now, the company was first movers in the terms of technology they used. They used a combined mill, which is used to grind cement, and they were the first ones using them. Now, from subtle but he got to know that even his competitors had a very positive outlook about Ramco Cement, and all his work staff was contented and happy.
The revenue didn't increase so much. It is
investing in companies whose PE from PBDT is around 3 times. Same happened with Ramco Cements, and thus this was an investment bet which he took and generated good returns. Now his second pick was Dr. Reddy. Dr. Reddy also made products which were not generally made by other people. From there, they too were the first movers, is when one of the global supplier of methyl dopa was shut down, they started manufacturing it. And when they got the news of them reopening, they shifted their manufacturing from methyl dopa to norfloxacin. The crowd was following them, but they were late. And when he attended Dr. Reddy's AGM, they got to know about the management and he was really amazed by them. Now, I would like to hand it over to Rishali.
So now let's look into the investment process of Govind Parikh sir. The first step is to select a company. As Parva discussed in the earlier slide, all the companies to be invested in go through a particular selection process and then they are selected. The next is platform ticket. He builds a very small position in any company he wants to invest in, then observes it carefully and further increases its allocation. For bigger bets, Govind sir likes to look into the quality of management. The next is building position. He likes to build a position in a decided price range only. For example, in case of Balrampur Chini, we can see the allocations have increased only when the prices have reached a decided price range. The next is to closely monitor your portfolio and churn whenever you find a better investment opportunity. He likes to limit the exposure of a single share to 10% of the portfolio and monitors the company by attending AGM through subtle but like visiting factories and to meet competitors. The next we would look into is what to do during downturns.
Thank you, Rishali. So, Govind sir suggests to be prepared for such downturns. The first thing he suggests is to maintain 10% cash at all times, which could be invested during such downturns, as even good companies are available at cheap valuation, and this could give a good upside even in the short term. Govind sir also suggests try not to time the market, as this could depress your returns. Let me explain this you by an example. So here we have made an investment where one investment is made just before the bottom and the another investment is made at the bottom. Here the investment that is made at the bottom would generate round to round 50% returns, while the investment which is mistimed would give 15% return. Now, let me show you the SIP returns. Here we have broken the investment corpus into 5 different installments. So the returns here would give a 61% return, while even the lump sum which was invested at the bottom would give less returns than the SIP investment. So this was done for the short term. Now, let me show you what Govind sir suggested for the long-term holding. He made a comparison that deploying cash during downturns could give similar returns to a 50% tax-free bonds. Here, I have shown you the returns where 5% tax-free bonds give a 34% return cumulative. A 50% tax-free bond gives 240% returns, while Nifty invested during the bottom of 2008 drawdown would give a 235% return, while the same investment after tax would give 211% return, which is very similar over a 6-year horizon.
Okay, so now let us take a look how Govind Sir prepares one for crisis. Firstly, he mentions that one should be bothered much about the principle. In the lieu of return, we should not bet on our principle, and that principle should be our first priority. Secondly, whatever investments we have made in equity markets, only 25% of the market value should be considered as ours. That is, he tells us to be even prepared for a 75% decline. If the 20 to 25% of that market value of the investment made is enough for your expenses, then even when markets will crash to like 70 to 80%, your lifestyle will be taken care of. Here he mentions that during the drawdown of 2008, the market crashed to almost 53%. So market instabilities can really affect your portfolio very much. But if you don't even want to be invested for a long period of time, then investing at the time of crisis can also generate good returns, because generally when markets see a decline, there is a recovery. Here's a graph by Funds India, which presents that after every market decline, there is an upcycle. So every crisis in the past has been followed by a recovery and further upside. So which brings us to the conclusion that whenever market declines, they tend to rebound, and investing at that very bottom will bring us really good returns.
So now in the do's and don'ts of investing, let's look into something to avoid. The first thing, leverage. Leverage is like fair with a friend. In the upside, it gives you huge returns, but in the downside can also lead to bankruptcies. Like in our example, we have equity of 40 CR and leverage of 60 CR. And as we can see, in the upside, it is giving enormous returns. But when the tables turn, we not only need to bear the interest cost, but also repay capital, maintain margins. Thus, we can conclude that upsides with leverage are lucrative, but the downsides take the steam off. The next thing to avoid is short selling without cover. As Govind Parikh sir did, he short sold Ingersoll Rand as it was an MNC, so he expected it to trade at 5 to 6 PE. With the EPS of rupees 25, he expected it to trade at the maximum price of rupees 170, but it was trading at rupees 190. So he started to short sell it. When the price started rising, he failed to cover it at rupees 250 and had to bear a loss of rupees 50,000. Thus, in short selling, the losses are unlimited, but profits are only till the extent of the share price. We should not short sell only on the basis of valuation, but also look into the fundamentals and the financials of the company. Sometimes investors delay in covering up the position as they expect prices to reduce further, but end up in losses as they cover up when the prices start rising. We should also look into the markets and not believe only in our conviction. So in the next slide, we would look into his views in trying to time the market.
So now we'll talk about exit strategy of Mr. Govind Parikh. While exiting, Mr. Govind says, if we have timed the trough properly, we should not try to time the peak. Instead, we should sell over time to average out our profits. The reason is, even if the prices go up after we sell, the markets normalize over time and maybe reverse back to. Our average price might not be as high as the peak, but it will be decent enough. Also, it reduces the risk of getting caught in the rally. We should definitely sell when the evaluations look absurd and cash, as timing the peak may not turn out as well as we think. By doing this, we can reduce our risk of getting caught in the momentum. Brief compilation. So in this slide, we are going to talk about what we have learned in this video. Filtering. While filtering, Mr. Govind thinks that the first and most important thing is to look at the fundamentals and the quality of management of the company. After that, we look at valuations, that is, if the company is overvalued or not. Scuttlebutt. As investors, we can only get around 50% of information from publicly available resources about the company. So Mr. Govind thinks that to gain information advantage over other investors, he likes to use the way of scuttlebutt. Investing. Once we have built conviction in the company, we slowly build positions by averaging. And once we have built positions, we monitor these companies in our portfolio very closely so that we know what is going on with the company. And we should maintain 10% cash at all times. While distress, once we have deployed cash, as market runs in cycles, we do not want to stress sell, and we should be ready to lose 75 to 80% of our invested capital, as these are the critical movements, and we do not want to get caught in the momentum and make losses. What to avoid? No one is correct 100% of the times in markets, so we should avoid taking leverage at all times. Another thing to avoid is timing the markets, as timing the markets can destroy our capital, and we can get caught in the momentum of the market. Short selling. Short selling has limited gains and unlimited possibility of losses. That is, it has a huge risk factor, and especially we should avoid naked short selling. Exiting. While exiting, we should not try to time the market, as we do not know when the rally will turn around and we get caught in the momentum of the market and lose our capital too. We should cash when the valuations of the company looks very absurd, and we should sell at multiple levels so that we get an average selling price, and we also reduce the risk of getting caught in the momentum of the market. So these were the learnings by Mr. Govind Parikh. In the next video of this series, Masterclass with Super Investors, we'll talk about insights and investment ideology of Mr. Ramdev Agarwal. Thank you.